What if I told you that the system controlling your money wasn't designed for freedom, but for dependence, like the credit cards in your wallet? The student loans you can't escape, and the national debts that never shrink, all trace back to an ancient idea, one so powerful, it's been rebranded and reused for over 5,000 years. An idea born not to create wealth, but to control it. Today, we're uncovering the ancient blueprint behind modern financial slavery, a system that began before banks existed, before capitalism had a name, and yet still decides who thrives and who serves. Our story begins in Mesopotamia, around 3000 BCE, where civilization, writing, and the first forms of accounting were born. Back then, money didn't exist the way we know it. People used grain, livestock, and silver to trade, but trade wasn't equal. Farmers often borrowed seed or tools from temple institutions in return for a promise to repay with interest after harvest. It sounded fair, until the rains failed. When crops died, debts remained. Families who couldn't repay were forced to sell themselves or their children into servitude. Debt wasn't just an economic concept. It was a system of social control. And here's where the blueprint begins. Those who controlled debt controlled people. The ancient Sumerians even recorded these cycles on clay tablets. Debt rises, the poor lose freedom. Revolt brews then, the king declares a debt jubilee, wiping the slate clean. But these jubilees weren't acts of mercy. They were acts of survival, preventing collapse by resetting the system. It was a delicate balance, the illusion of fairness, holding together a structure built on dependence. Fast forward 2,000 years to Roman Empire, fueled by conquest and credit. The Roman economy was built on taxation, interest, and military debt. Soldiers were promised payment in land or silver, but to fight, they often borrowed. The more wars Rome fought, the more it borrowed from its own elite class. When debt crises erupted, the same pattern repeated. Small farmers lost land to creditors, becoming slaves or serfs on the estates of the rich. Historians like Livy and Tacitus wrote about riots in the streets, desperate citizens burning records of debt. Rome's Senate tried to reform the system, but each fix failed for one reason. The ruling class benefited from the chaos, and so Rome's economic power concentrated into fewer and fewer hands, until the system collapsed under its own weight. After Rome fell, Europe plunged into feudalism, a system where land, not money, defined power. But by the 13th century, a new class emerged. Bankers and moneylenders. In Italian city-states like Florence and Venice, families such as the Medici learned a crucial lesson. You don't need a crown to rule a kingdom. You only need to control the flow of money. The Medici financed kings, popes, and wars, creating a network of credit that stretched across Europe. Their innovation, the double entry ledger, the mathematical foundation of modern accounting. It made invisible debt visible and trackable. But behind the numbers was something older, the same structure Mesopotamia used. Those who issue credit become masters. Those who borrow become subjects. Even religion reflected the tension. The church condemned usury, charging interest as immoral. Yet, every kingdom depended on borrowed funds. The moral outrage never stopped the money. It only forced it underground into private hands, family networks, and secret agreements. Thus, the first shadow banking system was born. By the 18th and 19th centuries, the Industrial Revolution changed everything, except the blueprint. Factories needed capital. Workers needed wages. Governments needed to finance wars and expansion. Enter central banking, a concept that promised stability but delivered control. The Bank of England, founded in 1694, lent money to the crown not from gold it owned, but from credit it created. For the first time in history, money was created from debt itself. Every note issued was a promise to pay back, not by metal, but by trust. This shift was revolutionary and dangerous, because if money equals debt, then debt equals control. Soon, this model spread worldwide from Europe to the United States. And in 1913, with the creation of the Federal Reserve, the ancient blueprint achieved its modern form. A private institution, empowered to issue public currency, lending to the government at interest. The system was self-reinforcing. Governments borrowed to fund spending. Banks create money through loans. Citizens work to repay debt with interest. The debt can never truly be repaid, because money itself is born from it. The 20th century tested the machine. World wars forced massive borrowing. The Great Depression exposed how fragile credit-based systems were. And in 1971, President Richard Nixon made a decision that sealed the modern blueprint. He ended the gold standard, detaching money from physical value. From that moment, all money became debt-backed paper. Or, later, numbers on a screen. It was the perfect system for unlimited growth and unlimited control. Governments could print money without gold. Banks could lend it without limits. Consumers could borrow endlessly. The result? A society addicted to credit mortgages, car loans, student loans, credit cards, all feeding the same cycle. And every crisis, from 2008's collapse to today's inflation, follows the same pattern. Those at the bottom lose assets. Those at the top gain control. The blueprint never broke. It just went digital. Across history, reformers have tried to break the pattern. In the 1930s, Roosevelt's New Deal imposed banking rules, but Wall Street found loopholes. In 2008, after the crash, governments bailed out banks too big to fail, while ordinary people lost homes. And when new systems emerged like cryptocurrency, promising decentralization, what happened? Governments moved to regulate it. Corporations built their own coins. The same forces of consolidation returned. Because any system that allows individuals true financial independence threatens those who profit from dependency. Freedom, in this architecture, isn't profitable. Today, the blueprint is evolving again into something even more sophisticated. Central banks around the world are developing CBDCs, central bank digital currencies. They promise convenience, transparency, and stability. But here's the hidden cost: programmability. A digital currency can be tracked, controlled, even deactivated. Imagine a world where your money expires if you don't spend it fast enough, or where a transaction is blocked because your carbon score is too high. This isn't fiction. It's being tested. And yet it's the same pattern repeating. Debt as control. Credit as a leash. Freedom, packaged as convenience. The ancient clay tablet has become a smartphone screen. The temple has become a bank. The scribes have become algorithms. But the blueprint is the same. So what do we take from this 5,000-year journey? 3 truths stand out. First, the system isn't broken. It's working exactly as designed. Debt was never meant to liberate you. It was meant to bind you. Second, every generation believes it's free until the cycle resets. From ancient farmers to modern citizens, freedom exists only in the gaps between crises. Third, the blueprint can only survive if we believe money is the measure of value instead of value being the measure of money. We stand at a crossroads. Technology has given us the tools to rebuild finance: transparent, decentralized, fair. But if we repeat history, we'll use those same tools to rebuild the cage, stronger than before. The question isn't whether the blueprint will continue, it's whether we'll recognize it before it's too late. If you found this story unsettling, good, it means you're awake. Now share it. Because the only thing stronger than the blueprint is awareness. The ancient blueprint behind modern financial slavery. Subscribe for more deep history and hidden systems.